Hey, good afternoon, everyone. Welcome to another edition of SRT Live. I am your host, Sean Richard. Thanks so much for joining me today. And this week is a blockbuster week in the mortgage and real estate, really the economic environment, the landscape. We've got the Fed meeting that's happening as of today and tomorrow. We've got some additional inflation news that we're going to talk about. And then we're also going to get into a few other topics. We're going to talk about rents, the cost of renting, what's happening there. And then we're also going to get into, sorry, pulling up the comments so that way I can answer any questions that we have throughout the broadcast. So also going to talk about the the future of interest rates. Where are we headed in the short term? Where are we headed in the long term? You've heard me talk about this before. We're going to touch on it today as well. So welcome in, welcome in, welcome in. Glad to have you here, coming to you every Tuesday on SRT Live. So let's jump into it. So let's start with some of the data. Let's go into kind of what's happening, what happened last week. And so as always, every Thursday, we get jobless claims. And so last week was no different. We get initial jobless claims, and then we also get continuing jobless claims. And so by jobless claims, I mean unemployment claims. This tells us kind of the state of the workforce, the state of employment. And so the weekly report is for the prior week. And so on Thursday, we got numbers for the week of the the week of the 28th through the 6th. So for that week, we actually got pretty spot on with what the market was expecting. The market was expecting 216,000 claims. We were a little bit above that. We were at 227,000 claims. Prior to that, the week before, we also got a reading of 216,000 claims. So the market was expecting pretty much to stay stable. I would say that overall it did. We had a $10,000 gap, or a $10,000 claim gap between what the market was expecting and what we actually got, which was relatively small. Did have a slight tick up, but we are going to have some fluctuation from week to week. Continuing claims are the number of individuals that are continuing to renew or to renew their unemployment benefits. So the prior reading, so last, I guess the reading on the third for the last week of February, that reading was at 1.469 million. The market was actually expecting a pretty sizable drop for this first week of March. And so they were expecting only 1.33 million. We actually got 1.49 million. So we actually ticked up a little bit from the previous reading, but we came in about 100,000 over expectations. And so as always, we want to keep an eye on those numbers. Employment is running very low right now, both initial and continuing. These are some of the lowest numbers that we've seen. We've gotten back to pretty much pre-pandemic levels on a lot of these unemployment claims. And of course, these are all released by the U.S. Department of Labor and Statistics. So you can always go check these out. Last Thursday, we also got CPI, Consumer Price Index, which is a consumer level inflationary report. Now, if you keep up with my videos, you saw that I jumped out and I did a video specifically talking about inflation. It came out red hot, so I'm not going to belabor the numbers too much. Month over month, the market was expecting a 0.8% increase. And of course, this is for the month of February. The market was expecting a 0.8% increase month over month. That's exactly what we got. Year over year, we hit the number on the head as well. We got a 7.9% increase year over year, and that's exactly what the market was expecting. January's reading, so year over year from January, which was released in February, was 7.5%. So we're still continuing to creep up. Now, I'll get into this in a minute, but what's kind of worrisome is that these numbers are for February. They don't take into consideration the spike in energy costs that we saw at the beginning of March associated with the Ukraine conflict. So we're gonna want to watch and see where the CPI report comes out for March, and it comes out in the month of April. We're gonna have to see where that comes out to see if inflation has peaked or if we're gonna continue to see that rise a little bit. I know we're all feeling it at the pump. We're all feeling it in the grocery store. And I mean, my wife let me know today that she went to Costco yesterday, and a bag of avocados were $10. We used to pay $5 a piece for those bags. So everyone is feeling it across the entire board, and we'd like to see that inflation peak. We'll talk a little bit more about that here in a minute. Today and yesterday, no major economic news, nothing super noteworthy. Today we actually got PPI. So CPI from last Thursday, that's Consumer Price Index. That's an inflation report at the consumer level. Today, we got PPI, which is Producer Price Index. That is inflationary report at the producer level, right? So at the manufacturing level. And the reason that this is so important is because inflation at the producer level is a great indicator of what's going to trickle down to the consumer level. But we need to bear in mind that not all inflation is going to trickle down to the consumer level, because at the producer level, manufacturers, producers, they have the ability, they have the decision on how much of their cost increase that they want to put forward onto the consumer. As a producer, as a manufacturer, if my cost goes up, I can say, you know what, I'm going to absorb some of that cost and have reduced margins and only going to pass a certain percentage onto the consumer. There's a number of reasons for this. One could be out of the goodness of their own heart. So rarely does that happen, but occasionally that might happen on maybe some smaller businesses. The second thing is going to be competitive, because if I'm a business and my competition is not passing all of the cost on to the consumer, then I'm inclined to do the same thing. So to be more competitive, or let's say that my competitors are passing almost all of the cost onto the consumer, I may make a decision to say, I am not going to pass all of the cost, and that's going to put me at a lower cost than my competition and help me drive more customers, more revenue. So there's a number of reasons that producers may elect to do that. But anyways, so we got Producer Price Index today, and we got month over month, and we got year over year. So month over month, we saw a 0.8% increase month over month from January to February. Now, this was actually a hair below expectation. The market was expecting a 0.9% increase. And then for January's reading from last month, we actually had a 1%. So this appears from the producer level that we could potentially be on the decline. But again, we don't see the impact from a couple things. One is from the Ukraine conflict, and two is what's going on in China, which I'll touch on again. I'll touch on it here in a moment. So that's what we got on a month over month. Year over year, Producer Price Index, spot on to the market estimates. The market was expecting a 10% year over year increase, and then we got a 10% year over year increase. That's still up a tiny bit from our January reading from February. So that was a 9.7. So we are still seeing a tick up there. And April's reading for the month of March is going to be critical. It's going to allow us to get a really good feel on whether we have peaked or whether there's still room to go on inflation rising. And that's impacting all of us. Now, looking ahead to this week. So the major focus for this week is the Fed meeting. The Fed, the Federal Open Market Committee, is meeting today and tomorrow to decide what they're going to be doing with monetary policy and interest rates. And when I say interest rates, I'm really referring to the Fed funds rate, and which is the short-term lending rate. Banks use it for overnight lending between each other. So that's what they're going to be meeting on today. So that's happening today, tomorrow. Tomorrow, we also get the NAHB Housing Index. This is the National Association of Home Builders who put this out. And this, the NAHB Housing Index is the gauge of home builders on their confidence in the housing market going forward. And then We get the Fed rate decision tomorrow. We are expecting a 0.25% increase in the Fed funds rate, and we'll know what happens with that tomorrow. And we're going to hear from Fed Chair President Fed Chair Jerome Powell at 1 o'clock Central tomorrow. So be on the lookout. If you like to follow that, you can likely watch his press conference tomorrow afternoon. But we're going to hear from Jerome Powell, aka Jay Powell. We're going to hear from him. That's on Wednesday. On Thursday, as usual, we get jobless claims. So we're going to get to see the next iteration of unemployment claims. We're also getting housing starts, which measures new construction, and that tells us the direction that we're seeing builders go. And then we're also going to get building permits, new permits pulled for new construction projects. And then on Friday, we get existing home sales. And that is going to be an interesting one because that's been declining lately. However, it's in large part due to inventory. You've heard me talk about the inventory. If you're a real estate agent, you know that we're seeing low inventory. If you're a buyer, you've heard everybody and their mom talk about low inventory. And so existing home sales, you can't sell what you don't have. So we'll want to watch for that on Friday to see if existing home sales declines with the shrinking inventory. All right, so that's what we've got to look forward to this week. Now let's dive into some key talking points on what's going on. All right, so let's talk about rents. We got CoreLogic's rent report. And man, that was a doozy. So if you think that buying a home is out of your reach and home prices are rising too fast and we're in a bubble, then boy, oh boy, you don't want to be renting right now. So according to CoreLogic, year over year, rents are up 12.6% year over year. Compared to last year at this time, rents were up about 4%. So we're seeing a significant increase in rents. Now, this report from CoreLogic takes into consideration new rents as well as renewing rents. So there's a mix of both of those, and we're seeing just a massive surge in rents. Renting is really no picnic as well. You know, it's as rents renew. Actually, quick anecdote: I had a client the other day tell me that they were looking to purchase a home, and they had talked to their landlord about renewing their lease if they needed to do that. Their rent was currently sitting around $1,600, and their new rent was going to be just shy of $2,000 a month, about a $300 to $400 increase over the course of that on that renewal. So that's a huge jump. And here's the key takeaway that I have for if you're looking at buying, or if you're a real estate agent and your clients are debating whether to continue renting or they're continue or try to buy. The number one piece of information that I like to make sure that everyone truly understands is locking in your cost. With a mortgage, buying a home, the actual mortgage, the principal and interest portion of your payment is set for the term of the loan. You know, if you're in a 30-year fixed, it's fixed for 30 years. If you're in a 15-year, it's fixed for 15 years. But your mortgage payment, your core mortgage payment, does not change for the entire life of that loan. With rents, if you are renting and you're on 1-year leases, because that's most of what's happening right now, your rent is going up year over year. So if you want to take a look at the cost of renting versus the cost of buying, reach out to me. My information is right here. Leave comments below. Happy to have that conversation, talk about your scenario, and help you make the right financial decision. Renting isn't necessarily bad, but you've got to make sure that you know all the details on what makes the most sense for your finances. And real estate partners out there, I know it's a challenging scenario for environment for your buyers. And so helping them understand the right financial decision is important. We're going to continue to see home prices rise. We're likely going to continue to see rents rise. And so it's more important now than ever to make the right decision and have all of the information to be able to make the most educated decision possible. All right, Let's talk Fed meeting. All right, so the Fed is meeting today and tomorrow. They're expected to increase the Fed funds rate by 1/4%, which is designed to combat inflation. And you've heard me say this before, inflation is the enemy of interest rates. And so the Fed increasing the Fed funds rate is a positive for interest rates. A lot of times interest rates react favorably when the Fed increases the Fed funds rate. Now, the $1 million question is going to be, is it too little, too late? We've seen inflation run amok. This time last year, the Fed was coming out stating that inflation is transitory. Inflation, they want to try and keep inflation around 2%. And here we are up around 8%. So is this too little, too late? We're probably going to see some positive movement, but that's also going to depend on what else the Fed decides to do, what other monetary policy, what other levers that the Fed decides to pull to try and counteract inflation and to improve the economy. So the other lever that they may talk about, that they may pull, this is what we've got to be on the lookout and listen for, is if they decide to start reducing their balance sheet. So the Fed has been buying treasuries and bonds, which includes mortgage bonds or mortgage-backed securities. Well, if they decide to start reducing their balance sheet, start selling these assets, these treasuries, these bonds, including mortgage bonds, then that is likely going to drive the price of mortgage bonds down. What happens when the price of mortgage bonds goes down? Interest rates rise. So it has a counter effect from what increasing the Fed funds rate would do. So that's going to be heavily in focus. I know I'm going to be looking at what the Fed says, what Jerome Powell comments on in his press conference tomorrow. That's going to be a critical component of which direction interest rates are going to go. If there's no plans to reduce the balance sheet and they're simply talking about increasing the Fed funds rate, and they come out and Jerome Powell says that they're going to do several additional increases to the Fed funds rate over the course of the year, mortgage rates are likely they're gonna like that information, and we may see a turnaround from what we've seen lately. Rates have been on the rise since the beginning of the year, and so we may see a nice reprieve from the direction that we've been going on interest rates if the Fed comes out and gives us that information. Conversely, if the Fed comes out, if Jerome Powell says that they're going to be cautious about additional rate hikes and they're going to start reducing their balance sheet, we're likely going to see interest rates continue to climb, and that pace may even accelerate. So we've got to be on the lookout and be on guard for that. So we've got some pretty critical components of the Fed meeting coming out tomorrow that are really going to influence the direction of where mortgage rates go. And we've seen prices rise, we've seen mortgage rates rise, all of which is not making it any easier for buyers in the marketplace. So navigating the marketplace is more important now than ever. Working with the right real estate agent is critical. Working with the right lending team is critical to navigate this market. All right, so let me turn a little bit to inflation, and let's talk about inflation. So you heard me talk about CPI and PPI. We got both of those in CPI last week, PPI today, and as I briefly touched on earlier, these readings are for February. This does not even factor into a couple of different things. One, it doesn't factor into factor in the Ukraine conflict. We've seen the price of oil surge since the Ukraine conflict. We've seen that trickle down to the price of gas at the pump. That's spread into so many other aspects of our economy. When the cost of oil goes up, the cost of everything goes up because it takes oil, it takes gas to transport goods. And so we've seen plane tickets rise. We've seen cost of groceries go up. We've seen goods across the board rise based on that. And so the inflationary reports that we've seen don't take into consideration the Ukraine conflict. And so could we see higher inflation on next month's report when April rolls around and we get the CPI and PPI reports for March? Could we see inflation continue to grow and show us that we have not peaked just yet? Now, once we peak, then we can start to breathe a little bit of a sigh of relief because we're going to start to hopefully see some reprieve from the high inflation rates, and we can start to see things improve a little bit over time. The second piece that is not being taken into consideration is over in China. China has recently had another outbreak of COVID, and they have shut down their Shenzhen region for, I believe, a week. And so you may ask yourself, well, I don't know anything about China. What does that mean? I'm shutting down their Shenzhen region. Well, Shenzhen in China is basically the equivalent of Silicon Valley here in the United States. And so it's a major hub over there in China. So shutting down the Shenzhen region has the potential to have additional supply chain impact. As if we didn't have enough supply chain issues already, we could see an additional or an exacerbated supply chain issues from the shutdown of that region. And so the CPI and PPI reports are obviously not taking that into consideration because that just happened here in March. So looking at those two reports for next month is going to be an important barometer on where we are in the battle against inflation. Has it peaked? Is it on its way down? Or do we still have room to go up, causing prices of everything to rise as well? So those are all pieces that we've got to, or all items, factors that we've got to keep an eye on over the course of not only this week, but also going into April and into the spring buying season. I do want to show you a couple quick things. I'm going to pull this up. Check this out. All right, let me pull this up for you. All right, I shared this on Facebook, but I want to share this with you real quick. So this is homes built in the United States by decade. So one of these things is not like the other. And so as you can see, we've seen a dramatic increase since the 1950s in home building. And that's been, we had a slight dip in the 60s, but that's been pretty much steadily growing over the course of time. Look at that cliff that we fell off of going into 2010 through 2019. And so when we look at the availability of homes, the inventory that we have on our market, there's a number of factors that's causing the environment that we're in right now. But the number of homes that have been built over the last decade is absolutely playing a role in the inventory that we're seeing now. And when you couple that with the large influx of home buyers in the millennial generation, our largest generation, that is causing extreme demand, and we have super, super low supply. These are not things that are going to go away in a month, in 6 months. These are issues that we're going to continue to see play out over the next number of years. So I predict that we're going to have a similar market to the one we're in now for a number of years to come. I've been telling people 3 to 5 years, could be more. You've heard me say there's an analyst out there that I heard that said 10 years. I don't know about that, but anything is possible. But we're seeing some really, really low numbers when it comes to inventory. And this is part of that right here. All right. So gang, I just want to say thank you so much for tuning in today for the weekly market update. Thanks for joining me on SRT Live today. If you have questions, put them in the comments. Hit me up on my contact information below. Happy to have those conversations with you. Until next time, have an amazing rest of your week. Take care.